"15 years after the global financial crisis, the US Senate is again looking into the cause of major banking failures.
It comes down to more basic concepts: hubris, entitlement, greed, and always, always, always with big paydays at the end for the executives at the top.
The warning signs should have been flashing red, and SVB should have stood out as what it was: absolutely a problem child. Clear as a bell were the warning signs.
The collapse of Silicon Valley Bank, or SVB, almost caused a full-blown banking crisis. Regulators are under pressure to explain why they didn't prevent it.
Let's be clear, these collapses also represent a massive failure in supervision over our nation's banks.
Essentially, the risk model was not at all aligned with reality. And the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours.
We had a failure of supervision. SVB made a basic rookie mistake in banking. They mismanaged their interest rate risk. Finance 101 says that when interest rates go up, the value of bonds goes down. I mean, it's pure mathematics. And what SVB did is they bought a bunch of long-term bonds that when interest rates went up, well, their value went down. And they went down enough that when investors saw that they'd lost a lot of money, they went and they pulled their money out.
Fear spread quickly. Within days, Signature Bank also failed as customers tried to withdraw their money. The regulators stepped in, guaranteeing all deposits at both banks to calm markets and prevent further panic.
Given the damage that a banking crisis can do, I would err on the side of doing too much, and I think that's the judgment they came to.
And what do you think now they're looking under the hood?
Economist David Wessel says the speed with which money was withdrawn from Silicon Valley Bank was extraordinary, $42 billion in a single day. It was a sign of how quickly things can turn as people move money at the click of a mouse or the swipe of a button.
I think there's two things that happen. One is you can move your money quickly, but the other is you can communicate instantly with other depositors. So the regulation and the supervision has to account for that. So I suspect when this is over, we will ask banks to have even more liquidity than they did before.
It's been a challenging time for the Federal Reserve, which sets interest rates in the United States as well as regulating banks. It's hiked rates at the fastest pace in decades to deal with soaring inflation, even though the Fed knows that the speed of those hikes could cause financial instability.
We are definitely in the midst of a banking crisis in which people are very concerned about the survivability of many banks and the banking system. So there have been systemic errors in banking supervision.
After a further rise in interest rates, many Americans are now alert to any further signs of banks facing financial stress.
When interest rates go up that fast, somebody is bound to get hurt. There's a guy on Wall Street who says there's a saying, I'd never heard it before, when the Fed taps the brakes, somebody goes through the windshield, you're just never sure who it's going to be.